Hey everybody, it's Chris Engelbert with Engelbert Financial Advisors in Allentown, Pennsylvania, and it's that time of month again. It's the 1st of August, so we are going to be doing the August update. You can see by my background, I have it looking a little hot. I don't know where you're at watching this, but we're in Eastern Pennsylvania, and we've had a couple of weeks of 90-degree weather, but that's also affecting, obviously, what's going on with the Olympics. If you've been following along, and I can go into a little bit of a rant on the Olympics. I have a questionable aspect on some of the sports that are now Olympic sports. Whatever happened to the decathlon? But anyways, that's time for another video. What I want to dive into today is what's going on in the stock market. By the time you see this video, we'll have had the jobs report for July. It will have come in light, and the markets are reacting violently on the downside. So this week, what ended up happening is that we started to get earnings from the Magnificent Seven, earnings from Amazon, Meta, and obviously Microsoft. And although Microsoft and Meta said earnings were good, there was an underlying tone as far as what was happening possibly in the fourth quarter of the year. That spooked the markets, and we started to see some of the Magnificent Seven stocks start to sell off. One of the interesting notes was that in July, we saw the baton handed off to small mid-cap stocks, which really have been undervalued. But unfortunately, in the severe market sell-off that we're seeing right now, we're beginning to see the small mid-caps pull back as well. Here's a chart of the S&P 500. We already blew through a 5% correction. We're fast getting into a 7% correction from the top of the market. I actually think that we are going to go a little bit deeper this time. If you remember back in April when the Fed, everybody was worried that the Fed was going to keep interest rates too high for too long, and that there was inflation out there, the S&P 500 sold off about 5%, rebounded, and then proceeded to make new highs in June, ultimately topping out in July. Now, one of the things that we've been doing all along through June and July is we've been raising cash and getting defensive. Our risk indicators peaked literally right around the middle of July, and obviously we are playing defense right now. If you had to press me on how deep this pullback is going to be, I think it's going to probably be a little bit bigger than the garden variety 5 to 10% pullback. If you remember last year, we saw August, September, and October a 10% pullback in the markets. I actually think we could end up being flat on the year for the S&P 500, and that would be literally around the levels of around 4,700 on the S&P 500. We'll have to see. We'll have to see what our risk indicators say. But right now, I believe that this pullback may be a little bit deeper than what people expect. So we are playing defense at this time. Again, here's a chart of the small mid-cap stocks. They really exploded in July. I don't think that this is a long-term head fake. And when we start putting money back to work in the markets here, in the next couple of months, depending upon how deep the pullback is, we are going to continue to favor small mid-cap stocks because they really look to be still undervalued at this point in time. The other thing that we want to focus on is what's happening with interest rates. Now, if you remember what happened last fall, is it looked like inflation was out of control. We saw the 10-year Treasury peak at 5%. And then again, back in the spring, you saw the 10-year Treasury get up to 4.75%. Well, look at what's happening now on this latest data that we got that's showing that the employment numbers are beginning to deteriorate, and all the revisions have actually been larger than what's expected. We're beginning to see the financial markets, especially the bond market, say, hey, listen, are we going to get a recession in the first quarter of 2025? We don't know if that's the case, but if you remember, if you've been watching our videos, we've been talking about the last several months to lengthen the duration by longer-term bonds in your portfolio. 3-month CDs are still where it's at. They're 5.1% as of this video. I think they'll be closer to 4.75% in the next couple of weeks. It's still very attractive. But again, if you've been lengthening your duration, you're locking in some of these yields. And I can make the case that bonds could actually have a much better performance this year than what people think. Also, we're watching crude oil. Again, what I'm trying to tell people out there is that this is what is a measure of inflation. And if you watch crude oil, not only gasoline prices, but all of the materials that are made out of plastics, you can see that crude oil has taken a sharp reversal lower We think that bodes well for future inflation numbers. But again, what we think now the Fed is going to end up being focused on, and remember, it was only 2-3 months ago where the Fed was saying we don't expect to cut rates at all. We are coming into August in something called the Jackson Hole meeting, where all the Fed governors get together in Jackson Hole, Wyoming, to fish for brook trout, etc. But out of the Jackson Hole meetings, many times comes some very important interest rate outlooks for the Fed as well as the economy. We think the Fed is obviously going to be changing their tune and say, well, we're not going to do a rate cut until November. Now it looks like there's going to be a rate cut in September and November. The question is how big these rate cuts are. And if you've watched some of our past videos, I have said that if the Fed starts cutting rates aggressively, at first, the stock market may cheer that on, but right now we're almost getting a Wile E. Coyote moment where the stock market's going, whoa, wait a minute. If the Fed's cutting aggressively, does that mean the economy is slowing down and i.e. future earnings are not going to be as good? Again, that's why we're defensive right now with equities. We want to see how this plays out through August and September before the election. So to sum it all up, the Magnificent Seven had a sharp rally in June, followed by a sharp rally in July. This was a precursor of what was to come. Small mid-cap stocks started outperform, but as of this video, we've seen a couple of days of sharp sell-offs across the equity markets. We think at some point in the fall, and we do not want to rush this, but at some point, September, October, when the markets finally, correct from overvalued situation, which we've been talking about for the last couple of months, that there's going to be some buying opportunities. We don't think it's this right at this particular time right now. Lower inflation readings and softening employment numbers, again, got the 10-year Treasury below 4%. We think eventually the 10-year Treasury could end up around 3.5% by the end of the year. And again, one of the things that's happening is although inflation is coming down, we still see it obviously in the grocery store, but I think in the next couple of months, you're going to see inflation ease a lot more than what people realize. And unfortunately, that's a byproduct of a potential recession in the first quarter of 2025. So stay cool this summer, enjoy your vacation, make sure your portfolio is defensive at this particular point. At some point, our risk indicators will have bottomed. It'll be a signal of buying opportunity. Make sure you watch our monthly videos because we will talk to you about that. If you want to get in contact with us, one of the best ways to do it is download my app. Text Chris E, C-H-R-I-S-E to 36260. All this content, including the video and the slide deck, are on my app, and it's a great way to communicate with me because you can email, text, or give a call to the office. That's all we have for the August update. We'll talk to you soon. Everybody take care.